Welcome, to multifamily enthusiasts. This is Hutch, the Marine Investor, and I want to welcome you to another episode of the Multifamily Real Estate Experiment podcast. And today we got a good friend with us today. What we're going to dive into is a little bit more of the Passive Investor series. Our guest today, second time on the show, is a full-time limited partner investor and the director of investor development at Ashcroft Capital. He dedicates his time to educating investors who are looking to be hands off when it comes to real estate. For those who don't understand what limited partners are, we'll dive a little bit into that as we go into our guest speaker introduction today. So, our guest speaker today is none other than Mr. Travis Watts. So, welcome to the show, my brother.
Hey, Hutch, it's so good to be back on the show.
Thank you so much for being here, brother. So if listeners want to know like your beginning journey, they can go back to a previous episode, which we'll make sure that there's a link in the show notes for that episode. A lot of things have happened since our last conversation. I think our last conversation was in 2020, or if not 2021. So it's been a long time, at least 2.5, 3 years. So a lot of change since then. So can you catch your listeners up about yourself and your current focus?
I'll just quickly recap it in a nutshell. I got started with real estate in 2009, and I got started with single family homes. So I did fix and flips, vacation rentals, I had some buy and holds. And in 2015, as I was trying to scale that up after numerous properties and some plus and some minus, I thankfully ran into a couple mentors that were older gentlemen. They had sold their business in the 1990s, and they were telling me that they were full-time LPs or limited partners, which I had no idea what that meant. So I asked them what they invest in, and it so happens they invest in a lot of private equity offerings, but their bread and butter, their favorite preferred asset class was value add, multifamily syndications. I had no idea what that meant. Years ago, driving past an apartment community, if you had asked me, who do you think owns that? I'd say, I don't know, a billionaire or a Wall Street firm. I have no idea. So I didn't know that individuals like myself and like you and like your listeners can actually pool capital together in smaller increments to buy these larger apartment communities. So it's a really great strategy. It's made all the difference in my investing career. And so I switched gears in 2015 after finding these two mentors to investing full-time as a limited partner. And when I say full-time, what I mean is every investment that I have is a hands-off passive income investment. I'm not a general partner. I'm not a flipper. I'm not an active owner. I'm not an individual owner. I'm investing in other people's deals and sharing in the profits alongside them. And I've found this to be just a very convenient, streamlined, simple strategy to use, and it's much easier to scale compared to owning and managing a bunch of single family homes. So that's the background. One of the groups I was investing with early on was Ashcroft Capital with Joe Fairless. Yeah. And I asked to come on board with their team in 2019 because I saw a great need for the marketing side of this business that was really lacking. No one really knew about this stuff. All these accredited investors out there, these doctors, dentists, engineers, business owners, had so much money in the stock market and just didn't realize there was alternatives to buying a bunch of single family homes. I think that's what a lot of us think of when we say real estate investor. You just assume, oh, you own some properties in your local market. There's a lot more to the game. And so I wanted to be a voice for that and show people through my own examples and the thousands of people I've spoken to that are limited partners, how this stuff works and how it can benefit you as an investor.
This is good stuff, man. So look, if you listen to this episode, it's going to be some impactful and powerful information. We're going to be talking about the 3 reasons why 2024 is a prime time to invest in apartment complexes. And look, Travis Watts have done over 50 deals as a limited partner. We're going to try to capture some of the information about that as well, some of the lessons learned from that experience. And we want to dive a little bit into asset management, material costs, and we also talk about some mitigating risk through portfolio insurance. So we're hoping to capture a lot of that information today. Without further ado, Travis, when you meet an accredited investor who may be well-versed in investing in the stock market, they understand how mutual fund work, They understand how annuity works and a whole bunch of these other technical investment strategies, but they don't understand what a passive real estate investor is. In fact, I was talking to one of my well-educated connection on LinkedIn recently about a deal that we have going on right now in Irvine, Texas. And I used the term passive investing. He was like, Hutch, I'm not sure I do that kind of investment. And then he asked the question, what is a passive investor? So can you educate our listeners just real quick on how do you a accredited investor to get a better understanding of what a passive real estate investor is?
Yeah, absolutely. So when we talk about a real estate private placement, which is the
Right.
technical term, or a real estate syndication, which is the term most of us use in the industry, what we're talking about is that you have a general partner or general partners, plural, and then you have limited partners, plural. So a general partner is the active person or persons in the business plan. They're out there looking for large commercial real estate. They're doing their due diligence. They're getting properties under contract. They need to raise capital alongside investors as well as themselves to be able to take down a large deal like that. So let's
Yeah.
just say, for simple math, they need $20 million for a down payment and for a renovation budget and for miscellaneous costs and what have you. So they're going to go out and market this deal to high net worth, high income individuals. And these individuals can choose to invest, let's say, $50,000 or $100,000 each. So you may have a couple hundred of them. It just depends on the deal size and the structure of what you're doing. But the limited partners like myself are the hands-off investors. Basically, I'm looking at this deal that someone else found, that someone else got under contract, that someone else is going to manage on my behalf. And I'm deciding, do I want to invest in it? Do I believe in that market, that deal, that operator? And so if the answer is yes, after doing my due diligence,
Yeah.
I might put in 100,000 alongside all these other folks. And so the money comes in a pooled strategy. And then the general partner executes the business plan. Okay, they choose what to do with renovating the units, when to refinance, when to exit the deal, and they're sharing in the profits alongside folks like myself. And
Yeah.
so, really, it's a front loaded business model for a limited partner, meaning I have to do my homework up front,
Yep.
decide what deals I want to invest in and how much, and send the money and sign the docs. After I do that, it's really a hands-off investment. I'm going to get monthly or quarterly updates and or distributions. And usually these projects will last anywhere from 3 years to maybe 7 years. It's different for every operator. And so we can get into some of the different business plans that are out there. But that's what it means to be a hands-off investor. So I can tell you, you were mentioning 50 plus deals. It's a lot easier to have 50 plus limited partnerships where I get a K1 tax form at the end of the year and have my
Right.
CPA take care of everything than having to own and manage and track receipts and keep QuickBooks and accounting and all this kind of stuff and do it all on my own. Even though I intended for that model to be
Yeah.
passive, when I started, it became a full-time job after a period of time. And there's nothing wrong with that if that's really your passion, your skill set, and what you love to do. I'm not going to bash the active model of single family flips or anything else. I made a lot of money doing it. It's just after so many properties, I had to choose, do I want to do this with my time? And the answer for me was I'd rather do other things with my time and just put my money to work this way.
I totally identify with what you're saying, my man, because I currently do both, right? Active and the passive. And I really
Sure.
do love receiving that check or the deposit in my account on a monthly basis from the properties that didn't really require any effort on my part. But the ones that we actively manage, holy crap, man, it's a day in, day out conversation with asset manager, property manager, compounding things and putting the documents together for tax around tax times. It's a pain in the butt, but we got it done because that's what we decide to do. But the goal is definitely to go towards full passive investing. Now, between the time that we last talked, Travis, and now, there's been a lot of changes, right? And there's a lot of speculation of what's going to happen, what has happened, what is happening, and what's going to happen in the investment world. With you that have done 50 deals and Ashcroft Capital, which is a pretty large company, I think they got over $2 billion in asset under management or somewhere around there.
Yeah, nearly three now. We're
Nearly
2.8
three.
billion. Yeah.
So, what I really want to ask you, Travis, you guys are still acquiring properties, and some folks might be sitting on the sideline. Can you help us to understand what are the key economic indicators that suggest that 2024 is a prime time for apartment investing?
Yeah, absolutely. So if I had to break it down to just three of
Right,
probably the biggest factors to consider in
right,
24, it would be number one, the Fed has, of course, aggressively increased interest rates. I think we're
right.
all aware of that, and that's to tame inflation because last time we spoke, to your point, 2021, the market was just taken off, right? The stock
Yeah.
market, the
Oh, yeah.
crypto market, the real estate market. It was hard not to make money in 21. That heated up inflation in a real big way. So the Fed steps in to cool down the economy by raising rates, making it harder and more expensive to borrow. In commercial real estate, what that did is it increased cap rates as well, because cap rates tend to track interest rates more or less. It's not an exact science. But in commercial real estate, when a cap rate goes up, valuations come down. The reason that we're seeing such awesome discounts, quite frankly, in the commercial space right now, as compared to, let's say, the single family space, has everything to do with debt structure. It's common in commercial to have very short term debt 1 year, 3 year, 5 year, 7 year. That's a common debt structure. And then it matures or it starts to amortize. Things change after a brief period of time. With single family, it's common to get a 30-year fixed rate mortgage, like many Americans did when interest rates were very low. In fact, it's something like 70% of Americans have an interest rate on their home that's under 5%. And so even though the Fed has raised rates, it hasn't really impacted individuals on a monthly basis if you're in a fixed rate term
Yeah.
because your payment's not changing. So it's only going to affect you if you sell your home and buy another, or perhaps if you're a first-time home buyer looking to enter the market right now at high interest rates, then it affects those individuals. So, long story short, the deals we've been acquiring over the last 2 years have been purchased at about a 25% discount relative to 2021 pricing. So that in turn is the opportunity. It's an opportunity to buy the dip at discounts we haven't seen in nearly 15 years coming out of the Great Recession, 2008, 9, and 10.
Right.
We're closing a property right now in Orlando, Florida, that's an A-class 2021 built property at a 5.5% cap rate. So it's about $97 million purchase price. If we go back to 21 and you say, okay, I got $97 million, or that's the property I'm targeting, what can I buy? It would have been like a 1985 Class B value add type of project. So we're able to level up right now in this type of environment, buy newer, nicer product at about a 25% discount and below replacement cost. So it's a short-lived window, Hutch, where it's already been unfolding. Of course, bear markets only last, they're much shorter than bull markets, we'll say
Right.
that. So we've already been in this bear market over 2 years. So it's starting to turn around. You're starting to see groups like Blackstone and JP Morgan and Jeff Bezos backing a real estate company. They're all coming in with billions of dollars to buy up real estate while it's on sale. So what happens when rates start to come back down over the next few years and these huge players are jumping in and scooping up everything they can is we start to get the recovery and the rebound. So 2024 really is the short-lived window of opportunity if you're looking to get into the game. Now, the second thing I would mention is supply and demand, which of course is the fundamentals of real
Yeah.
estate. And the National Multifamily Housing Council suggests that we need to build 4.3 million more apartment units between now and 2035 to keep up with the demand for apartments. Developers have largely scaled out of the market because of interest rates
Yeah.
going up and the cost of materials and wages. And so, on one hand, we're not building at near the levels that we were in years prior, and we're already behind by millions of units. So, where does that put you as an investor or an owner in 3 to 5 years from today? Something to think about. The last thing I'll say is to revert back real quick to the single family home stuff. if you're entering the market to buy a single family home right now, you've got nearly all-time high pricing and really high interest rates. And the gap between a new mortgage payment and apartment rent in America is nearly $1,000 per month differential. So that just makes more demand for needing rentals and people deciding, I'm just going to rent right now until something happens. Single family homes come down in price or interest rates come down in price where I can afford to make that kind of investment. So those are three key things to consider, things that we have not seen in years prior. And again, really not in the last 15 years, never since I've been a full-time limited partner. So I see 24 as one of the best years so far that I've ever seen in this sector.
Yeah. So I think it's really important for our listeners to understand how market cycle works, right? And also understand some of the requirements coming out of the Great Recession that lenders placed on their buyers. Now, during 2020 and 2021, the lenders had significant amounts of requirements for people who are buying apartment complexes, right? So the fundamental is there, and a lot of folks have incorporated having deals that are well capitalized, not just getting debt structure, but also having a lot of reserve. A lot of those reserves are running out because a lot of folks who bought property on a higher or on adjustable rate interest had to use a lot of those reserve, right? So some of those properties that we've seen as well. How should a passive investor approach risk management given the current market condition whenever they're reviewing a deal that may come through their email in the not so distant future?
Yeah, the first thing I'll point out, not just in self promotion here, but for the
How about you?
last 2 years, I felt it was very important as we were entering into this market cycle shift, which is a capital market cycle shift. It's not
Right.
that the fundamentals of multifamily have an issue, it's the capital markets changed. And so valuations changed, distress changed, everything changed there. I started writing a report that I publish every quarter on behalf of Ashcroft Capital. It's called the Market Insights Report. We're about to put one out here in July for Q3. And what I do is I pull data from all the reputable national sources. Therefore, I'm not being biased towards what one opinion is. I'm saying, here's what CBRE says. Here's what Marcus and Millichap says. Here's what the Urban Land Institute says. Here's what the U.S. Census Bureau says. And I'm putting it all together to showcase where are we in the market cycle right now and where the opportunity lies so that you can get an unbiased opinion of that. So to answer your question, one is to understand the fundamentals of the fact that, again, we're buying an A-class property at a 5.5 cap. And so in a lot of markets, that same property in 21 was maybe a sub 3% cap rate. The purchase
Yeah.
price could have been 130 million, not 97. So just to understand how and why those discounts occur. The second thing I would say is I've always been an advocate for betting on the jockey, not the
Yeah.
horse, right? The deal is certainly important for sure, but I used to get way too caught up in the deal itself. And I wasn't really looking at who was going to be running the deal, how they were going to manage the deal, what their track record was. So that's really important right now, more than ever, because we're transitioning to a period where easy money was at play for many years,
Yeah.
and value add was dime a dozen, right? We're going to go buy this 300 unit complex. All the units need to be turned. We're going to get 200 or 300 a month per unit rent bumps. It was pretty easy going, relatively speaking. Now it's going to be an operations and management type of value add. Okay, who's really in this business, who can operate and perform? That's where the value is going to come from, because a lot of the value add has already been sucked up and renovated, right? So
Mhm.
it's hard to find that 300 unit where none of the units have been touched for 15 or 20 years. In most cases, at least half or more have already been turned.
Yeah, so the jockey is definitely important. Then we started out back in 2019 in the multifamily space, and we have gradually improved the quality of operators that we are investing with. Not that we invest with bad people; these are amazing people. But as we go forward, we start looking for those people who have a vertically integrated company with construction management, property management in-house, which is the topic we're going to talk about here shortly. So that concludes the state of the apartment investing market in 2024. I want to roll into our second segment, which I want to talk about some of the lessons learned from you as a veteran limited partner. right? This is segment two. So you've done 50 deals, and I want to talk about the three lessons that you have learned, and amongst other things. Reflecting on your journey, Travis, what are the top three lessons you've learned from your 50 deals?
Yeah, I would say the first is to check in with your psychology because if you ask any investor, are you short term or are you long term as an investor? Most everyone says I'm a long term investor. However, when markets shift and markets go down and volatility happens, a lot of people start looking for the exits and saying, okay, I'm on the sidelines. I'm not doing any more deals. Things just got scary. I don't know what to do. I'm just going to wait and see. So again, this is an opportunity in 24 to buy the dip. It's an opportunity to dollar cost average, which I've always been an advocate for. It doesn't matter what I'm investing in. You could draw a parallel to stocks if I'm going to buy an index fund for life, and that's my strategy. This is the stock market 25% down. Are you a buyer? Of course, right? You're going to scoop up the dip, and then you're still going to buy next year no matter what the market's doing, and then you're going to buy the year after. And there's going to be periods of time where you're buying at peak levels. And there's going to be times where you're buying the dip. And there's going to be times where you're buying in the middle. But over the long term, you're going to get the average results this asset class. And for multifamily, it's been somewhere in the 9% range on an annualized basis. Some metrics say it's higher. And we're not including or just talking about value add where you can force appreciation. Those have actually been higher returns annualized. But just multifamily in general. So something to think about. It's so hard to time markets. I've talked to so many people over the years who have strong opinions about we're going into recession or this or that's going to happen or we're going to see this huge wave of foreclosures. And like it just doesn't materialize because there's so much out of our control. We don't know who's going to win the election. We don't know what policies are going to pass and which ones aren't. We don't know when the Fed's going to cut rates and how much and how aggressively and how often. We don't know these things. We can't predict natural disasters and all this kind of stuff. So don't try to time the market. Just average in every year. I'm investing as much this year, if not more, than I did the previous year and the year before. And I was a buyer in 21. It did scare me that prices were skyrocketing the way they were.
Yeah.
But I still bought in, okay? And so it's all going to be fine in the long run. The second lesson I've learned is that a sole focus on just appreciation is not the best strategy, okay? So I've been a long-term advocate for cash flow. I like deals that offer monthly cash flow plus potential equity upside and forced appreciation plus tax advantages. So you got a threefold strategy there. And if one of those goes away, you still got two working in your favor. And you're not just saying, like when I used to flip homes, there was only one strategy and it was buy low and sell high. And if the market worked against you, you don't make money or you lose money. I don't like strategies like that. So focus on cash flow. And I can also tell you, let me just hit on this because we talked about floating rate and fixed rate debt. I've worked with a lot of operators in the space. I've done floating rate deals. I've done fixed rate deals. I've done deals that the operator buys and never projects to sell. That doesn't mean they're not going to sell. It just means I don't know when they're going to sell. I might be in a deal for 20 years. Some of the deals that I got in 2017, 2018, maybe even 2016, I'm still holding in my portfolio with long-term fixed rate debt on them. Distributions haven't stopped. Capital calls aren't even on the table. Cash flow continues going up year over year. And so you can choose models that make sense for what your needs are. You can truly be diversified, in my opinion, within commercial real estate. A lot of people would assume that's just one segment. I can't just have all my eggs there. I need some stocks and some bonds and some mutual funds and some gold and silver and some crypto and some real estate. That could be fine. I'm not telling you what to do. I'm not a financial advisor. But what I am saying is you can invest in multifamily, self-storage, mobile home parks, hotels, hospitality, industrial, land plays, note lending. I mean, there's a lot of asset classes. And then within those asset classes, there's fixed rate debt, there's floating rate debt, there's lower leverage, there's higher leverage, there's different geographies, there's different business plans. So you can really put your money out there in a very diversified way. And as I look at my portfolio in any given year, I've got deals that are not performing so well, and I've got deals that are outperforming, and the vast majority are just performing at expectations. So
Yeah.
it's just a realization as an investor that you're not always going to hit a home run. 2015 through 2019 is not a repeatable strategy. Every 5 year tranche is going to be different. Keep diversifying is one thing that I've really learned. I really like multifamily for the reasons that we pointed out, the supply and demand dynamics. Everyone needs a place to live. It's hard to outsource a place to live with technology or the internet or AI or things like that. So it's here to stay, at least for the timeframes that I'm investing within, 10 years or less in most cases. Longer term is up for debate. Are apartments going to be a thing in 100 years? I don't know, but they're certainly going to be here in 10 years. I can assure you that.
Yeah. So those some great ninja tips, man. Travis, I want to go into the next question, right? Touch briefly on how have your strategy evolved from your first deal to your 50th. I know you started in the single family space. It definitely was not passive. You went into the future, brought it to the present, shifted your strategy a little bit. So how have your strategy evolved from your first deal to your 50th?
Yeah. One thing that hasn't changed is multifamily value add of some sort. It could be
Okay.
operational value add. It could be literally turning units. It could be a combination of the two. But from 2015 through today, I still seek that type of business model. And the reason is back to those mentors that have been doing this since the mid 1990s through today. They opened up their portfolio to me to show me 2008, 9, and 10 and all the good and all the bad. It's a sustainable strategy if you stay in the game.
Yeah.
Okay. So that's one thing that stayed the same. Some things that have changed is that when I first started, I didn't know what I didn't know, and thankfully I could realize that. And so I didn't know which groups were going to be the best. I didn't know who had the best track records. I didn't know how groups are going to perform. So I started by just doing very small tranches of capital, and I hyper diversified. 25,000 here, 30,000 there, 50,000 there, and I just did a ton of deals early on. But ever since, I've been able to gain more insight as to how these folks are communicating with me,
Right.
how they're executing the business plan, what deals they've brought full cycle, what deals they haven't sold that were intended to be sold, different things. So I've honed in to probably my top, let's say, 7 operators that truly have underpromised and over-delivered. I invest a lot more with them, and my minimum investments have gone up additionally because it became a little bit of a pain point for accounting when you have 50 plus K1s with 25,000 investments. So I started doing a little bit more heavy investing there.
No, that's good. Appreciate you sharing that. Can you share some specific challenges that you face in a deal and how you overcame it?
Yeah, the thing about being a limited partner is, again, you're relinquishing control, okay, over the business plan. So you're
Right.
really relying on this group to do things in your best interest. And so that in itself is always a bit of a challenge, right? If you happen to disagree, okay, we're going to sell this deal now and give you a 10% return when maybe we could get a 20% return next year, but we're not willing to wait. The benefit, of course, is that you can do far more deals and far more markets and far more business plans, and you can really scale up your portfolio. I've been in deals that were really struggling. They had to pause distributions. They were mismanaging things. They had to fire their property manager 3 times. Just stuff happens. And I think what got me through it, truthfully, is just having the right mindset and perspective. Just like with any investment type, if I went out there and I said, I'm going to invest in 50 stocks, I'm just going to pick 50 companies I like and I'm going to put money there. You've got to understand that some are not going to perform the way you hope, and some
Yeah.
are going to outperform, and some are going to be somewhere in the middle. And that is just how investing goes. You can look at the best investors in the world. You look at the Peter Lynch and the Warren Buffetts and the Carl Icahns and the George Soros. They've all lost money. They've all had deals go south. They've all predicted one thing and something else happened. The key is to diversify and to get an average dollar cost average return over the long haul.
Yeah, to that point, we sold a property recently in Georgia, and I like to get on the phone and speak to all the investors and the ones who answer the phone. We have a conversation about how do we go, what to expect after closing. And I was talking to one of the investors, and one of the things he brought up was like, Hutch, we didn't double our money as we projected on this property, but we made a return. And he went on to talk about some of his other deals that did not perform so well. They were doing capital calls. He also had a deal that actually went back to the bank. So to your points, understanding track record, choosing the right jockey, and maybe 5 to 7 people that you want to invest with repeatedly that demonstrate a good track record. That would help you. So whenever you're going through challenging time, for example, if they need to switch between property management company, you have developed the relationship that is built on trust that they are doing the right things to ensure that the property performs or as projected.
I couldn't agree more. You want people that are really in this business
Right.
as professionals. They
Correct.
intend to stay in this business. They intend to not only get through this market cycle, but do another 10 or 20 years
Right.
after. That's who you're trying to find, individuals like that. And again, a group that maybe says, we're willing to wait this out and put in the effort, even if
Yep.
it means reducing our fees or waiting an extra 2 years or giving some other kind of incentive. And that they have skin in the game. They're investing in the deal too. That's important. That's something I really learned from working with one of the largest brokerage firms in the world before I got into this business, is there was a huge lack of alignment of interest, right? I was being told to sell products to people that I myself didn't invest in and didn't believe in, and I couldn't do it. I tried it for a few months, and I'm like, all I want to talk about is real estate and what I know to be the tried and true path. And I had to quit because I was like, I can't tell someone they should potentially invest in something when I'm not doing it myself. It just feels very hypocritical. So that's what I love about this particular niche and industry.
Yeah, so that leads me directly into my next question, man, because look, some folks are on the fence. Some folks are new to the real estate syndication space. Some folks have been burned in the syndication space because of the jockey that they've chose or the sponsorship team that they've chosen. So with you who have done 50 deals, what advice would you give to a new limited partner, a passive real estate investor looking to get started in real estate syndication?
Yeah, I would say there isn't a perfect group, right? There isn't a Yelp, so to speak, online where you just say, hey, I just want the 5 out of 5s and don't show me anything else. So you have to do a little bit of trial and error there. What I would say is that, especially now that we've gone through this interest rate cycle, when we talk about track record, there's probably going to be deals that either broke even, lost money, or did maybe a low single digit return. That is not necessarily a red flag. It doesn't
Right.
mean, oh, you had a deal gone bad, I'm not investing with you. If you go back to the data and you look at December of 2021 and what the Fed was expected to do with rates over the coming years, it was projected to modestly go up to a Fed funds rate of about 2 to 2.5% over
Yep.
the next 2 year period. What happened is it went to 5.5%. They went more than twice as aggressive as the forecast. Now, you think about being a general partner in December of 21, what other data did you have to really go by but the Fed themselves and the economists and the projections and Bloomberg and Morningstar? All the data was saying that rates will modestly go up. So this is why so many people had the floating rate loans with
Right.
maybe interest rate caps and things like that. And so just because, again, something out of their control, largely, it went up way faster and more aggressive than anyone thought, put some deals into stress and jeopardy. Maybe it meant pause distributions. Maybe it meant a capital call. And in a weird way, I'm glad that numerous deals I'm in went through some of this, pause distros, capital calls, etc., over the last 2 years. As much as, of course, I don't want that for my portfolio, it
Right.
teaches you a lot of lessons, and it really it makes you tune in. It makes you say, wait a second, what happened? Why did it happen? How did it happen? And then you start to understand risk, which is something almost nobody talks about in space, is risk. There's risk in everything. So it's just, you ask the operator, hey, that deal I see here on your track record, you gave investors a 5% return or a break even. What happened? What were the lessons learned? What did you learn from that you're now doing differently on the next deals that you're going to be closing? you're just looking for competent answers, just people who are humble and honest and transparent. And so just know that projections are just that. They're projections, they're not promises or guarantees. And there's going to be deals that do well and deals that don't. And so that's why you diversify and do dollar cost averaging in as many deals as you can do.
I put together a tool for passive investors, which is the definitive due diligence guide for passive real estate investor. And what it is just asking the right questions, right? So to your point, understanding the pain points that those investors went through or those operators went through that caused the deal not to perform as projected, right? For a deal that did not bring the returns that was projected initially when it was purchased. So that's good points. And I appreciate you bringing those out. So the last question in this segment is, how do you evaluate potential deals now compared to when you first started?
Yeah, I would put three main areas of risk are the operator, the deal, and the market.
Right.
So I put the heaviest emphasis, let's call it 50%, on the operator. Their track record, their ability to execute the business plan, my trust in them, their transparency, their communication. To me, this is really the most important thing. The second thing would be, we'll call it 25%. You could change 2 and 3, the deal or the market. So we'll talk about the market. Markets have a huge impact. I remember this from investing solely in Colorado in single family homes. The reason so many of my flips did well and my VRBOs and all this kind of stuff was because the market was just ripping. It was hard not to make money. You could just literally go to the MLS, buy almost anything, and then wait 2 years and make a profit, right? It was just simple. You didn't have to do value add. You didn't have to be creative. You didn't have to be good at business.
Yeah.
I was mistaking that as my own success for a while until I realized how much impact the market really had. So you want to go where jobs are being created, employers are moving there, people are moving there. You can look at all this data online for free. There's so many CBRE and CoStar and Marcus and Millichap. There's a lot of sources out there that will show you, even U-Haul stats. You can look for free. Where are people moving to and where are they moving out of? So you want to be in those growing, expanding markets. It makes a huge amount of difference to the business plan, even if the operator can't execute properly in a lot of cases. And I was in some of those deals where really the operator flopped almost 100%, didn't really do anything they intended to do, but we were in a great market at a great time at a great price, and we made money as LPs. So pay attention to markets. The deal itself, if you're working with an experienced operator in a great market, again, there's less emphasis on the deal because they're probably doing a good deal in the first place, but the deal is certainly important. I like these days B and A assets, Class A, Class B, the newer, nicer product, not necessarily brand new. I don't do new development investing, nothing like that, but I started to shy away from the C and D stuff. Usually it's higher risk, higher return, right? So everyone can choose what makes sense to them. But I found a lot more problems arise on the C and D properties with crime and vandalism and quality of tenant, demographic, different things that can pop up. I like true value add where you're taking something that's older, outdated, but stabilized and occupied, and you're bringing it to its highest and best potential. Where, think about it from a renter perspective. You're shopping the market for a place to rent. Here's this brand new luxury high-end place. It's $2,700 per month in rent. And now here's this Class B that just got renovated, and it's got a really nice gym, a really nice pool, a dog park, walking trails, matured trees, amenities galore, clubhouse, office, mixed use space, all that stuff. But the rents are $1,900 per month, right? So you're going to save hundreds of dollars per month. You're not going to be in the newest, greatest thing, but you're going to be in something pretty comparable, as at least, from amenity packages and a unit standpoint that's been recently turned. I like that. That's where most renters is in that middle category. So when you see big downturns and recessions, 08, 09, 10, et cetera, a lot of the high paying jobs and people renting A-class properties, they tend to step down to a Class B, and you've always got people moving up in the economy no matter what. So they're going from their Class C or D into a Class B. So it's just the catch-all is somewhere there in the middle. So I love that asset type.
No, great example. Those three things that you look for: the sponsor, the market, the deal. Those are three important things to look in. So that complete that segment. And the next text segment, I'm gonna combine the last three segment into one, and I want to focus more on cost savings, just to be respectful of
Yeah.
your time. So as we learn from these experience, man, it's essential to discuss practical ways to improve investment efficiency, such as cost savings. So I want to touch briefly on things saving cost of material, and then we roll into property management, vertical integration, and then we touch on how to control one of the things that are really uncontrollable, which is insurance. For
Sure.
cost
Yeah.
for cost savings, and we could try to make this a fire round, capture as much information as possible. What are some of the strategy for sourcing material at reduced costs?
Yeah, it's a great question. So I'm going to jump back and forth between vertical integration and our procurement process at
Okay,
Ashcroft Capital, which
thank
has
you.
resulted in about a 30% cost savings on our materials when we renovate units. So
Yeah.
we waited till we got to scale to go vertically integrated. Some groups go vertically integrated day one, some wait till later, and some never do. What vertical integration is you have your own property management, at least that would define vertical integration. We have our own property management, our own construction management, and our own trademark procurement process. We waited till we had over $1 billion under management in assets to go vertically integrated. Now, Sure Home is what we call our procurement process, where we're buying direct from the manufacturers. They're being shipped from overseas to our warehouses in Dallas, Texas, where we have our Birdstone headquarters, which is our property management group. We're assembling these small kits with most of the materials that our units are going to require when we turn a unit. All the smaller things, with the exception of the large, bulky stuff, not countertops, not flooring, not cabinetry, not appliances, but like cabinet pulls, shower rods, door handles, light fixtures, ceiling fans, stuff like this. And then we're shipping from Dallas in a shipping crate direct to our properties, where the shipping crate will often go to the backside of the property in the parking lot. And we've got our own on-site team to open it up, and they have all the materials and tools down to like the nails and screws and tools that they're going to need to start renovations, maybe 20 to 50 units at a time, something like that. The benefits are when you go direct to a manufacturer, we launched this during 21, 22, when we were seeing a lot of supply chain disruption. A lot of things were out of stock, out of order. A lot of things were getting marked up because of inflation. And so we save 30% compared to many competitors. There's a higher return on investment to our investors because this cost savings flows directly through to them. And then we get custom designed product, which on
Yeah.
one hand you could say, oh, so what? But it's really important. I don't just mean for the look of it, where our properties stand out from the crowd in the market. What I mean is, we'll take our light fixtures, for example, a flush mount light that we're going to put in nearly every unit we have across over 21,000 units that we've acquired. A standard flush mount light, let's say at a local hardware store, you're going to pay 30, 40, maybe even $50 for a flush mount light. It's going to have two light bulbs, usually sold separately. You're going to have to purchase those. And then if you're installing that light and you break it by accident, most often you're going to go back to the hardware store and you're going to have to buy a new one. Our flush mount lights, we have, because we get them custom designed, they're sleek, they're smaller, they're LED. It has an LED bulb, but it has one bulb, not two. They're energy efficient. And if that glass breaks, we actually store the parts and the pieces to these components on site. So we can go slip a new glass slider in there for 50 cents. We don't have to go replace the whole light. Okay.
Yeah.
And you think, oh, whatever, it's $30, it's $40. Again, we've acquired 21,000 units, right? So let's run the math. $30 times 21,000 units. And the ongoing maintenance is so much less. And again, it has us stand out from the competition. The other thing it's done is it's shortened our turnaround times to
Yeah.
14 to 21 days per unit, where it used to be about 10 days longer on average when we were having to scramble around and find all the pieces and components. And it's very environmentally friendly as compared to you show up to a Home Depot or a Lowe's and you say, okay, I need 1,000 of these shower curtain rods. You're going to get these big, bulky, boxes full of styrofoam and plastic and color packaging and all this kind of stuff. You just don't need it when you go direct from manufacturer. We're going to buy 1,000 shower rods in one box with virtually no plastic, no styrofoam, shipped directly to us. So there's just a lot of efficiency in it. And these are some of the operational advantages that you might consider, whether you're a GP or to understand at a greater level as an LP.
That is a great point. That's something we did. One of the property we bought in Georgia is we knew we wanted to renovate all the units, right? So we partnered with a distributor to where
Yep.
whenever we get ready to turn the units, they brought all the boxes with all the agreed upon components. And our property manager would have better prediction of what it will cost to actually turn a unit. Also, to your points, whenever something break, we know exactly what the cost would be to fix these components that broke. So that's great, great points. Appreciate that. We talk about cost saving, and it's definitely crucial, right? Because when you are going into a property, and if you're consistent across all your assets of exactly what you want to install, then that gives you more predictability. So let's talk about the vertical integration real quick.
Yeah. Vertically integrated from our standpoint is property management, construction management, and our own trademark procurement process all under one roof in one house. We waited till we got to scale to launch it. We were facing really three challenges, and that was alignment of interest, okay, like attention to our portfolio specifically, using a third-party vendor, or I should say third-party vendors. It just wasn't there. No one cares more about your property or your investment than you, the owner, right? And then we also struggled with the lack of talent that was being hired. We really didn't have much control or say over it. Whoever they hired, whoever they put on our properties, it is what it is. That's their deal. That's their business, right? And then they had insufficient infrastructure for our growing needs as a company. We were just acquiring properties there for a while, like 7, 8 deals a year. And we were comprising 40% of our third-party property managers' portfolio before we went vertically integrated. They had a lot of clients. So we were just outgrowing and outpacing for the needs and demands that we had. One example on the construction side, they would have one individual overseeing dozens of general contractors, just one person. From our construction management side, we've got 40 staff members, management level staff members overseeing the dozens of contractors and subcontractors. It just results in a much greater emphasis on attention to detail. What have we seen after going vertically integrated? Higher quality of culture now that we can do in-house training and we have a heavy management staff to be accessible on site and to train our employees. Improved KPIs, things like vacancy and collections have improved over the portfolio. More accountability across the board. And again, full control over the costs. If you're going to go pay a third party 4% to manage your property, let's say, just for simple math, and they're doing a mediocre job, you still have to pay them 4%. So in our case, we can control these costs. We can bring a 4% down to a 3, down to a 2, down to a 0 if a property is struggling and we need to help supplement the operations there. So it just adds to a lot of efficiency there. And again, it's not for everyone. And I don't know if it's best to do what we did and wait to get to scale or to do it from day one. The point is to consider, whether you're an LP or a GP, consider vertical integration and what benefits that could have to your investors.
Yeah, most definitely. That's one of the biggest struggles that we have had, and we have seen a lot of our operating partners that have as well too, right? Some of our friends in real estate have is dealing with a property management company, because the property management company will definitely make or break your business plan, like really make or break your business plan. Having the vertical integration of construction management and also property management really gives the operator more control of the assets, coupled with if they're going directly to manufacturer or a key distributor, then that helps to streamline the process significantly. One of the things over the past couple of years, Travis, that a lot of us have struggled with is one, of course, costs of managing the property. And one of the two things we do not have control of, one, taxes. But there's ways to work with the different cities to mitigate some of those taxes. But insurance, what are some of the risks in multifamily investment that insurance can mitigate?
It's a great question. And I would say, first of all, that's one of the great things about a investment type like real estate is
Right.
that you can have insurance, right?
Yes.
If you have a flood, a fire, or miscellaneous, right? And policies can, you can add on so many addendums and different features. And a lot of people don't even realize this, especially from individual homeowner
Right.
perspective. So we're a company that owns properties in multiple states. And to your point, Hutch, Texas and Florida, which we operate in, we've seen heavy property tax increases over the last 5 years and insurance. So what we opted for is called a master policy, or you could think of
Okay.
it as a portfolio wide insurance policy. We cover every single asset we have as a company in one policy, whether it's in North Carolina or Georgia or Texas or Florida. And so it helps to offset the premiums, number one. Of course, just think about just again, zoom into just a personal individual perspective. When you have an insurance company and you say, I'm going to put two cars on my policy or maybe a third, and I have a home and I'm going to add that and an umbrella, you start to get discounts, right? So we get a discounted rate overall on the master policy. But more importantly, if like we're acquiring this new Orlando deal, and that's one of the states with a large increase, it's going to be offset by maybe one of our properties in North Carolina where rates are a lot cheaper. And so it's all going to come out in the average. So that's one thing. But the other thing is that we have full actual replacement cost on our policies. So if one property really had a catastrophic event and had to be 100% rebuilt, a lot of policies that are individual will just give you a guesstimate or an average cost of rebuild in the area or based on some competitors. We get full actual replacement costs, material, wages, everything it's going to be required to rebuild that property. And that's really important because I think a lot of people are underinsured and don't even know it, especially from an individual perspective. If you haven't kept up with that over the last several years with the high increase of single family homes, I looked at our policy the other day and it was like 280,000 below what homes are selling for. I know they can do it at a discount and things like that as far as a rebuild, but still I wanted that to be higher in case something did happen. I wasn't out of pocket 280,000 plus my deductible. The other thing is, let's take Florida for example, because we have a lot of properties in Florida. Let's say a hurricane comes through this year and it affects 5 properties out of whatever we have out there, 13 or something. We can pull one claim with one deductible, and we can get all of those properties repaired and back up and running. So much more efficient than having to go around, pull 5 different policies and track all that kind of stuff. Then we also have a reimbursement clause in there. So if we have to displace tenants or the unit's no longer livable, so we have to move somebody and pay for something, we get the equivalent rent that we would have received from that resident while they're not occupying the unit. So these are just things, again, as an LP to check in with the GPs. What kind of insurance policies do you have? Is this covered or that covered? And cash reserves and that kind of stuff. And as a GP, if you're not doing this and you do own multiple properties, especially in different states, this may be a very big cost savings for you. So something to think about.
That's ton of golden nuggets, my brother. I really appreciate you. So I know we've been going it for a little bit longer than we projected, and there's so many more things that I could have asked you, Travis. Maybe we get you on to dive a little bit deeper into these topics on one of our quarterly Own More for America virtual summit. So let's look forward to doing something like that. Were you married in 2020? Well, last time we talked?
We got married in
Okay,
2018.
2018. Okay, but then since then you have had a child.
Yeah, we had our son in late 21. So after we
Man,
spoke.
yeah, congratulations on that one. So things have changed. So I was gonna omit the focus round, but I want to see how things have changed or how you have recalculated things, both in the improvements of your investment strategies, the
Mhm.
investment improvements of the company policies and company growth, but also your family growth, right? We're gonna dive into the focus round. So what do you now do for fun, Travis?
What do we do for fun? We live just outside of Walt Disney World in
Okay.
Florida. And so we had to make a decision when my wife got pregnant. We were out in Denver, Colorado, bouncing back and forth from Florida. And we had to decide the downtown city life during the pandemic or Disney World. We chose to come out here. We spent a lot of our time at the parks and different things out here. We love the lifestyle, the weather. It's a no tax state and things like that. So we just run around with him. It's the simple things right now. He's 2.5, so it's the water parks and stuff like that. We were actually all day at the water park yesterday. So that's how life has changed on a
Yeah.
personal note.
Especially as a limited partner, man, you get to do those things, which
Yeah.
is that's the time freedom that you get to have as a limited partner. So between 2020 and now, what is one opportunity that was a game changer for you?
Between 2020 and now, a game changer for me. I think back to the heart of our conversation today, the deals that I've been investing in over the last 18 months is just my personal belief. I think are going to do better than almost any other deals that I've done since 2015. Now, that
Gotcha.
doesn't mean every single deal and if not a promise or guarantee, but I'm just saying this is going to be a game changer when we look back 5 years from now. And I say, I'm really glad that we didn't just sit on the sidelines and wait that period of time out. That's probably the biggest thing.
That's good. That's good. So in previous years, right, things was going good, right? Then we went through the COVID season, and then we went to this
Yeah.
interest rate season last year, right? How much more value do you place on communication since the last time we spoke?
I've always placed a huge consideration towards communication because that's
Right.
just my personality type. Even when I first started, if I had emailed a group saying, I'd like to do a deal with you or put me on your deal list or have a question about your offering, and I didn't get a response for 2 weeks or ever, I just didn't do a deal with them.
Yeah.
And then as things started to get choppy, I really started to appreciate groups that kind of leveled up and took it a step higher and said, look, we're not just going to send you the occupancy and the collections on a monthly basis. We're going to show you all the detailed financials, where we're at in the business plan, what our projections are, what's happening in the news and media. They took the initiative to really inform investors on what's going on because a lot of operators got complacent with not needing to do those things because the market was doing well and their deals were doing well. Investors tended not to care so much and not really dig into things because it's, yeah, to your point earlier, I'll put my money in a deal and I'll double it in 5 years. That was the cliche for
Correct.
many years. But when things changed and that wasn't going to be the case, people started to turn an ear in and say, wait a second, what exactly is happening and what exactly are you doing about it? So communication's huge, probably one of my number one things to consider.
So over 50 deals, what is one thing you wish you understood earlier?
Oh boy. Just basic economic fundamentals, which is why I write the report that I write
Correct.
every quarter. It was just overwhelming. Like I didn't know where to look. And then you'd get on these major media outlets, and then one day they're saying things are great, and the next day they're saying recession. And it got overwhelming. I didn't know what to think or, what was good and what was bad. So that's why I don't know anyone else that's doing a report like this where you pull from 10 different sources and say, here's all the data. You get to read between the line pretty easily, and it's
Yeah.
not swayed in one bias type of way. So I wish I would have paid attention to that because really I was too focused early on just the deal.
Yep.
How good is this deal? What's the age of this deal? What kind of roof does this deal have on it? And I just wasn't paying attention to the operators and the economics behind it.
That's good. To what do you attribute your success?
To what do I attribute my success? I learned a valuable lesson years ago before I started doing this LP stuff. And it was, I made a goal for myself. First of all, I said, I'm going to read a book a week, 52 books a year. And I did that. And I don't recommend that because it's way too much information. It was, drinking from a fire hose. And so what I attribute, how I define that later is I'm an advocate for get some education, whether it's one book or one mentor or one conference that you go to, fill your head with some new knowledge and then take a little bit of action and see what the results are. Okay. Then go back to the education, get more informed, and then go out and take a little action again. It takes a little self-discipline, a little bit of willpower, but it truly is a balance, right? You can't just go into information overload because you don't take any action, and you don't just want to jump into taking action without knowing what you're doing. So find that equilibrium.
No, to your point, I think it's Bruce Lee that talks about it. I'm paraphrasing right now. It's that said a dangerous man is not the man that knows a thousand moves, but a man that practice one moves a thousand times. So to your point, man, a lot of us we try to do too many things and we end up doing nothing. You know what I mean? So I was working with a captain recently. He called it laser. He said a lot of action, zero result. A lot
Yeah.
of action, zero results. So a lot of people can be laser focused, but we have to continuously produce results by taking a calculated action towards a specific goal. So, Travis, I want to thank you for joining us on this podcast. If our listeners want to get in touch with you, how did they do that? They also mentioned about your newsletter as well. How did they get on that list as well?
Yeah, so actually, I made one landing page for everyone with multiple things that you can get value from. So if you go to ashcroftcapital.com/Travis, I have my calendar link if you want to jump on a 15-minute call and talk about anything. It's a non sales call, it's just anything that we discuss on this podcast or anything else. You can download financial trackers for your investments. You can read the newsletter that I write every quarter. It's completely free. And you can look at current offerings and opportunities like the deal that we're closing in Orlando. So ashcroftcapital.com/Travis.
Okay. Thank you, my brother. And I want to thank you again for listening to another episode of the Multifamily Real Estate Experiment podcast. I'm Hutch, the Marine Investor, out.